Good afternoon to all of you. I am Dr. Rajesh Kumar Singh, Associate Professor in the Department of Business and Management, Silas Campus. First of all, I welcome you in the family of Jaipur National University and very much congratulations to join JNU. Very congratulations to you on becoming a member of JNU family. So today I will deliver a lecture on double entry system. Friends, we know accounting records transactions and events in a systematic manner. So there are certain methods, certain techniques of recording the transactions. It starts with the recording in the day book and ends with the finalization of the account, which we call final account. From this, it starts by entering in the day book, which we call daily transaction register. From day book, we pass journal entries in the journal, and from the journal, we make ledger accounts. We open ledger accounts to have balances of the accounts. After having ledger accounts, we prepare trial balance to check arithmetical accuracy of the accounting records so maintained, and from the trial balance and other additional informations, we prepare final accounts, which include profit and loss account and balance sheet. So if the transactions are not recorded in a systematic way, then it will not give a fair and correct view of the state of affairs of the business. Neither we can determine profit or loss accurately. There have been so many methods of accounting transactions so far, which include single entry system. Single entry system means recording some certain important events only, and less important transactions are ignored, and maintaining some debtors account, creditors account, cash accounts, all are done under single entry system. But that is not accurate system for determining profit or loss or for assessing the financial position of the business concern. We have also our own system of recording transaction, which we call Indian system of accounting, which you would have seen a red colored book in which having a thread in which old Indian businessmen of ancient times have used to record transactions in that book. But double entry system is a systematic and accurate method of recording the accounting transactions into the books of accounts. If we follow double entry system, there is no chances of any mistake, of any other type of limitations are not there. All the accounts will be prepared in a systematic manner, and they will reflect a fair and correct picture of the state of affairs. So, what does double entry system says? Double entry system says that every transaction have twofold effect. One is debit and one is credit. One transaction affects at least two accounts. At least two means it may affect more than two accounts. It may be 3, 4, but there should be at least two accounts which are equally affected from the same amount. If an account is debited with rupees 1000, then another account will also be credited with rupees 1000. That means there is a credit for every debit and debit for every credit. This we call double entry system. In this system, transactions are recorded in a systematic manner, and they are debited or credited on the basis of types of accounts. So what are types of accounts for maintaining accounting record? Accounts are divided into three parts under double entry system. They are personal accounts, real accounts, and nominal accounts. Personal accounts are those accounts which relate to a person. This person may be a natural person or an artificial person, like Ram, Shyam, Rajesh, Mohan, OBT Limited, Reliance Industries Limited, Means it may be an individual or maybe a firm or body corporate. These are grouped under personal accounts. It starts with the name of a person or name of the firm or name of the institution. So if there is any personal account in the transaction, then it will be debited or credited according to the rule of personal account. The rule of personal account is debit the receiver and credit the giver. If anyone receives something, then he is debited. If anyone gives something, he is credited. For example, machinery purchased from Mohan. So Mohan is a person and Mohan is a personal account. So machinery purchased from Mohan. So Mohan is supplier of the machinery. He is giver of the machinery. So he will be credited. Second important is real account. Real account relates to some asset. It may be an tangible asset, intangible asset, real asset, or in real asset or fixed asset, whatever type of asset is that, it relates with the name of asset, any asset. If account is related with the name of any asset, then it is a real account and it will be debited or credited according to the rule of real account. The rule of real account is debit what comes in and credit what goes out. Whatever comes in the business is debited and whatever goes out of the business is credited if it is a real account. For example, if we make payment to creditors, if a business house make payment to creditors, then in making payment to creditors, cash, that is money, will go out of the business. Cash is an asset. Cash in asset is an asset. Cash in as asset, though, so it is going out of the business. So it will be credited. If cash would have come into the business, then in that case it would have been debited, and if it goes out, it will be credited. So for the purchases or payment of creditors, cash will be credited, and if we receive payment from debtors, then cash will come in the business, then cash account will be debited. So if the account is a real account, it will be debited or credited on the basis of rules of the real account, which is debit what comes in and credit what goes out. The third account is nominal account. Nominal account is that account which is neither personal account nor real account. Instead, it is related to expenses or losses, incomes or gains. Noteworthy thing is, if any account is related to income or expenditure, profit or gains, then it will be a nominal account, and this will be debited or credited on the basis of rules of nominal account. The rule of nominal account is debit all the expenses and losses and credit all the profits and gains. Once again, debit all the expenses and losses and credit gains and profits. So for example, if salary have been paid, salary is an expense for the business enterprise. So salary have been paid, salary is an expenditure will be debited. So salary will be debited. So under double entry system, the accounts are prepared on these three principles, which we call golden rule of accounting, which are based on personal, real and nominal accounts, and accounts are debited or credited on the basis of rules of the concerned account. These are: for personal account, debit the receiver and credit the giver. For real account, debit what comes in and credit what goes out. For nominal account, debit all the expenses and losses and credit all gains and profits. This was developed by Lucas Pacioli, double entry system and rules of debiting and crediting. But the modern approach of maintaining record has divided the accounts into 5 categories. Modern approach of recording transaction has divided the accounts into 5 categories. They are asset, liabilities, capital, expenses or losses, and revenues and gains. I repeat once again, modern approach of classifying the transaction divides the accounts into 5 categories. They are assets, number 1 assets, number 2 liabilities, third is capital, fourth is expenses or losses, and fifth is revenue or gains. And accountants worldwide have developed some rules on the basis of these categorization. For recording changes in assets or expenses or losses, rule is increase in asset is debited and decrease in asset is credited. Whenever any asset is purchased, it is debited, and whenever any downfall is any asset is sold out, it is credited. Second is increase in expenses and losses is debited, and a decrease in expenses and losses are credited. For recording changes in liabilities and capital or revenues or gains, the rule is increase in liabilities is credited and decrease in liabilities is debited. Second, increase in capital is credited. Increase in capital means additional capital has been introduced in the business, and decrease in capital is debited. Third, increase in revenue or gain is credited and decrease in revenue or gain is debited. So this was the rule of making transactions recorded according to double entry system. Now we will come to analyze some of the transactions. Here we have taken some examples for analyzing the transaction. First transaction is Rohit started business with cash of rupees 5 lakh. So if we analyze this transaction, the transaction increases cash on the one hand and increases capital on the other hand. Increase in assets are debited and increase in capital are credited. Therefore, record the transaction with debit to cash and credit to Rohit's capital. The second transaction we have taken is opened a bank account with an amount of rupees 4,80,000. If we analyze this transaction, we find that the transaction increases the cash at bank on the one hand and decreases cash in hand on the other hand. Increases in assets are debited and decreases in assets are credited. Therefore, record the transaction with debit to bank account and credit to cash account. The third transaction we have taken for analyzing the transaction is bought furniture for rupees 60,000 and issued check for the same. This transaction increases furniture. Furniture is an asset for the business concern on the one hand and decreases bank. Bank means cash at bank, which is also an asset of the business. So on the one hand, it increases some asset, that is furniture, and at the same time, it decreases an asset, that is cash or bank. So furniture will be debited and bank stands for cash account. Whatever cash we keep in bank, for that we use bank account, not cash account. So furniture account will be debited and bank account will be credited. The third transaction which we have taken for making analysis is bought plant and machinery from Ramji Lal for business for rupees 1,25,000 and an advance of rupees 10,000 in cash is given. So if we analyze this transaction, we find that this transaction increases plant and machinery, which is an asset, by rupees 1,25,000 and decreases cash by rupees 10,000. Simultaneously increases liability. Whatever portion have not been paid by the business, that will remain as a liability. So liability is created for rupees 1,15,000. Increases in assets are debited, whereas decreases in assets are credited. On the other hand, increases in liabilities are credited. Therefore, transaction will be recorded as debit to plant and machinery account, and credit to Cash and Ramji Lal's account. Next transaction which we have taken is goods purchased from Sumit Traders for rupees 55,000. If we come to analyze this transaction, we find that this transaction increases purchase and increases liabilities because cash has not been paid to Sumit Traders. So liabilities and expenses both have been increased by rupees 55,000. So increase in expenses are debited, and increase in liabilities are credited. Therefore, record the transaction with debit to purchase account and credit to Sumit Traders account. Next transaction we have taken is goods costing rupees 25,000 sold to Rajni Enterprises for rupees 35,000. Analysis of the transaction reveals that the transaction increases sales, which is a revenue, and business assets. Rajni Enterprises as a debtor, we will sell goods, they are called debtors, and from whom we make purchases, they are called creditors. So here Rajni Enterprises is a debtor for the business enterprise, are debited and credited in the revenue. Increase in assets are debited and increase in revenue are credited. Therefore, the record will be maintained as credit to sales account and debit to Rajni Enterprises account. So accounting entry will be Rajni Enterprises debit to sales account. In the last we have taken an example of expenditure, which is paid the monthly store rent rupees 22,500 in cash. The payment of rent is an expense which decreases capital, thus are recorded as debits. So credit cash to record decrease in asset. Paid monthly store rent. Whenever rent is paid, we can analyze any transaction from both the angles, either from personal, real and nominal accounting point of view, or from the angle of modern approach. So first we come to traditional approach, in which accounts have been classified into three categories: personal, real and nominal. So paid monthly store rent rupees 2,500. I repeat once again, which I said earlier in the beginning of the lecture, that double entry system says that each and every transaction will affect at least two accounts. So monthly rent paid have also two types of account. One account is rent. Rent is nominal account because rent is an expenditure. And the second account is cash. Cash is an asset, so cash is a real account. Expenses are nominal accounts and all expenses are debited, so monthly rent will be debited. And the second account is a real account. The rule is debit what comes in and credit what goes out. So in paying rent, cash is going outside the business enterprise, so cash will be credited. So entry will be monthly rent debit to cash account. If we take another transaction in which goods costing rupees 25,000 sold to Rajni Enterprises, here also there are two types of accounts. One is Rajni Enterprises and second is goods. Goods is a asset because if goods would not have been sold, then it would have it would lie in the stock. So stock is an asset, and asset is going out, so it will be credited. So we bifurcate goods into 4 categories. When we make purchases of goods, then we write simply purchase for it. When we return from these purchases, we write it purchase return. When we sell goods, we call it sales account, and when some customers return the sold goods, that we call sales return. So in this transaction, there are 2 accounts. One is goods, which we call sales, and the second is Rajni Enterprises. Rajni Enterprises is a personal account, and the rule of personal account: debit the receiver and credit the giver. So if the business entity has sold goods to Rajni Enterprises, then Rajni Enterprises is the recipient of goods. Being recipient of goods, Rajni Enterprises will be debited according to the rules of personal account, as Rajni Enterprises is the receiver of the good. And second is goods have been supplied out of the stock, which is an asset, which is a real account, and the rule of real account is debit what comes in and credit what goes out. So on selling goods, the goods are going outside the business enterprise, so this sales account will be credited. Another transaction, goods purchased from Sumit Traders, same thing, goods are coming, which is a real account. So purchases account will be debited from Sumit Trader. Sumit Trader is a giver of the goods, so credit the giver. Any transaction can be analyzed from both points of view, either from traditional approach, in which we divide the accounts into 3 parts: personal, real, and nominal, or we can adopt modern approach, in which the transaction is analyzed in 5 categories. They are capital, liabilities, expenses or losses, revenues, and gains. So whatever approach we follow, we have the same result. We have to debit one account and credit another account with the same amount. This debit and credit is done in such a way that there is equal effect on both the sides. If any account is debited by rupees 10,000, then some other account will also be credited by the same amount, that is rupees 10,000. Here is an example in which furniture has been purchased for rupees 60,000, and the supplier of the furniture has been paid by issuing a check. From the modern approach, we have analyzed the transaction and found that this transaction increases asset, which asset? Furniture, on the one hand, and decreases another asset. And every transaction will have at least 2 accounts. It doesn't means either it will have personal and real, or it will have real and nominal, or it will have personal and nominal. It will affect at least 2 accounts, means the 2 accounts may be the same type of accounts. Like in this example, both the accounts are real accounts. Furniture is also an asset and cash is also an asset. So both the accounts are related to same category, but there are 2 accounts, and these 2 will be credited or debited. So there may be one account twice, or there may be 2 accounts separately. So please be very careful in analyzing the transactions and posting the transactions into journal. Whatever transaction we take, that may be analyzed with both the approaches. They are traditional approach, which we call golden rule of accounting, or it may be recorded with the help of modern approach, in which we have categorized the transactions into 5 categories. First one is assets, second is liability, third is capital, fourth is expenses or losses, and fifth is revenues or gains. So these were the rules on which the premises of accounting has been erected, and on the basis of which the accounting records are maintained, on the basis of which accounting records include journal, ledger, trial balance, profit and loss account, and balance sheet. So this was the rule of double entry system of debiting and crediting the accounting transactions and events. So I think it will be helpful for you for understanding the concept of double entry system and accounting records. So thank you very much. Thanks a lot.